Have you ever wondered how one man turned $7 million into $600 billion? That's Warren Buffett, and his timeless investment secrets can help you build wealth too. Known as the Oracle of Omaha, Buffett has achieved an incredible 19.8% annual return through his company, Berkshire Hathaway, compared to just 9.9% for the S&P 500. His strategies are simple yet powerful. And today, we're diving into the key secrets that have made him a legend in the investing world. Whether you're a beginner or a seasoned investor, there's something here for you. So let's get started. Let's kick things off with the cornerstone of Buffett's approach: buying stocks that are undervalued. Essentially, finding bargains in the market. But how do you spot these hidden gems? Buffett uses tools like the price-to-earnings ratio, or P/E ratio, which compares a company's stock price to its earnings per share. A low P/E might signal that a stock is underpriced. Another technique he relies on is discounted cash flow, or DCF, which estimates the present value of a company's future cash flows. Take Coca-Cola in the 1980s, for example. The company was struggling, but Buffett saw its strong brand and global potential. He scooped up shares when they were cheap, and today, Coca-Cola is a cornerstone of Berkshire's portfolio. Or consider American Express in 1964. After a scandal tanked its stock price, Buffett recognized its resilience and invested heavily. That bet paid off big time. Want to apply this yourself? Start by researching a company's fundamentals. Check its earnings, debt levels, and position in its industry. If a solid company is trading below its intrinsic value, it could be your next great investment. Now that we've covered finding undervalued stocks, let's talk about what you do after you buy them. Buffett's second secret is holding investments for the long term. He's famously said his favorite holding period is forever. Why? Because this approach taps into the power of compound interest, where your returns generate even more returns over time. Here's a quick example. If you invest $10,000 at a 10% annual return in 10 years, it grows to $25,937. In 20 years, it's $67,275. And in 30 years, it skyrockets to $174,494. That's the magic of compounding. Look at Buffett's investment in American Express. He bought shares in 1964 and still holds them today, enjoying decades of steady growth. Many investors try to time the market, jumping in and out, but Buffett warns against this. Short-term trading racks up fees and misses the big gains. The lesson? Buy solid companies and hold them for years. Resist the urge to trade too often and let time work its magic. Long-term holding is powerful, but it only works if you know what you're investing in. That brings us to Buffett's third secret: only invest in businesses you understand. He sticks to industries he knows well, like insurance, consumer goods, and banking. For years, he avoided tech stocks because he didn't fully grasp their models. But in 2016, he made a big move into Apple. Not because he saw it as a tech company, but as a consumer goods giant with a loyal customer base and a powerful brand. This principle is critical. If you don't understand how a company makes money, you can't judge its value or risks accurately. So, how do you put this into practice? Start with industries you're familiar with. Read annual reports, follow industry trends, and even test the company's products. The more you know, the smarter your investment choices will be. Once you understand the business, you need to buy at the right price. That's where Buffett's fourth secret comes in: the margin of safety. This means buying stocks at a price well below their intrinsic value, giving you a cushion if things go wrong. For example, if you think a stock's true value is $100, buying it at $60 or $70 gives you that safety net. Even if you misjudge and the value's only $80, you still come out ahead. Buffett often waits for market dips or a company's setbacks to snag these deals. During the 2008 financial crisis, he invested in Goldman Sachs at a steep discount, confident in its long-term worth. The takeaway? Don't pay full price. Look for discounts to lower your risk and boost your returns. Beyond these secrets, Buffett's entire philosophy is built on value investing, a concept he learned from his mentor, Benjamin Graham. He hunts for stocks the market has overlooked, ensuring they come with a margin of safety. He zeroes in on companies with strong fundamentals, consistent earnings, low debt, and competitive advantages, like a unique product or a loyal customer base. This disciplined approach skips the hype and focuses on long-term wealth. You can adopt this too. Do your homework, trust the numbers, and tune out the noise. Patience ties all of this together, and Buffett has it in spades. He says the stock market transfers wealth from the impatient to the patient. By holding investments long-term, you ride out short-term ups and downs and let compound interest do the heavy lifting. Buffett waits for the perfect pitch, resisting the urge to act impulsively. This takes confidence in your research and the companies you've chosen. For him, patience isn't just about waiting, it's about trusting the process. Here's where Buffett breaks from the crowd. While many preach diversification to spread risk, he prefers concentrating his investments in a handful of companies he knows inside and out. Diversification is protection against ignorance, he says. By focusing on your best ideas, you avoid watering down your returns with weaker picks. This takes guts and deep research, but it's a strategy that's paid off for him. It's not for everyone, but it's worth considering if you're willing to put in the work. Emotions can sabotage even the best plans. Fear and greed drive people to buy high and sell low, the opposite of what works. Buffett stays cool-headed, sticking to his strategy no matter the market's mood. His famous advice? Be fearful when others are greedy and greedy when others are fearful. This lets him capitalize on market overreactions while others panic. Keep your eyes on the fundamentals and don't let feelings steer the ship. Even Buffett isn't perfect. He's had flops, like his investments in Dexter Shoe and Energy Future Holdings. But what sets him apart is how he handles them. He analyzes what went wrong, learns from it, and adjusts his approach. Mistakes aren't failures, they're lessons. Take that mindset with you. When something doesn't work, figure out why and get better. So, there you have it, Warren Buffett's timeless investment secrets. Find undervalued stocks, hold them long-term, understand the business by with a safety cushion, and embrace patience, focus, and rationality. These ideas can work for anyone, whether you're starting small or managing millions. Of course, investing comes with risks, and past performance isn't a crystal ball. Always do your own research before diving in. If you enjoyed this video, give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss out. Drop your thoughts in the comments below. We'd love to hear from you. And stick around for our next video on common investment mistakes to avoid. Thanks for watching.